Everyone see this okay?
Mm-hmm. Yep.
Yeah.
All right, perfect. So again, my name's Paul Ratner. I work for a company called Marble Bridge Funding Group. I see some people that have seen my presentation before, so I'm sorry if this is repetitive. I may have a bit new insights or information from some of my recent experiences. But again, our company, Marble Bridge Funding Group, has been around almost 30 years. We work with small businesses and startups on raising capital. Little interesting background about me. If you go look on my LinkedIn, you will find that I actually have a lot of experience working in pro sports. So I work a lot in business development, revenue generation. That is my area of expertise. I have an immense amount of knowledge in the amount of small businesses we work with at Marble Bridge Funding Group as far as it comes to raising capital. I'm going to go through some of that today. Feel free to put questions in the chat. Feel free to raise your hand. I'll try and call through you. I'd like to make it a little more interactive. I know in a virtual setting that's harder to do, but feel free to interrupt or put a question in the chat and I'll try and answer it. So I'm going to start by going through the different capital funding types that I think about and what people I think should just have general knowledge about. When you're operating your business, I know most founders think from the lens of, I know this particular trade, I know how to build this moat, I know how to sell X. You have to think about places of getting capital. These are the 7 areas that I'm going to kind of reference and kind of talk through in the lens. I see the question too, asking for Q&A only at the end. Feel free to ask at any time. I think it's easier to do it in chat, but if you won't need to raise your hand because I'm not getting to it or you want to chime in verbally, go ahead. Try not to talk over people. But these are the 7 different things that I think you should all know. And I just have it organized alphabetically here. But I think the biggest thing to think about is banks' role in capital. And the reason why federal interest rates matter so much, not only just from getting debt, but it matters from getting money from investors. And the reason being is if loans are more expensive at the banks, interest rates are high, that means if you're putting money in the bank, you're getting more interest on your capital. So an investor may be less interested in putting money as an LP in a venture fund. They may be less interested, and that's why it would be harder to maybe raise money as a fund because interest rates are so high and they have more guaranteed money than they did previously. Whereas when they're putting money in a venture fund, there's more risk. So the banks and the interest rates, that really at the end of the day is kind of controlling where the money is going. And that's because it's a risk valuation for anybody putting capital in the market. The banks offer all the core services from debt at the cheapest rates because they work with the SBA, Government Institution Small Business Administration, that offers capital that they back, meaning if they approve the loan, they will repay the debt that the capital, the bank put out. So that's why a bank would like an SBA loan. And those are government rules that they've put in place to be able to help small businesses. I think some of the biggest things you have to think about in taking loans from a bank or the SBA is a UCC filing. Does anybody here not know what a UCC is? You can just say yes or no in the chat. So it stands for United Commercial Code. So somebody will file that at the government entity, the lender will file that, and that means they have a lien on the business. And usually the UCC filing has a statement of what the actual lien is. So a UCC1 is a blanket lien, meaning that they have a general lien on the whole business. There's more specific liens that you might be more familiar with, which would be real estate. So somebody gives you a loan on a building, but we also have residential real estate, but this is for commercial, right? When they file a lien, UCC lien filing. You'll sometimes see it on an individual, on commercial or residential, like if you bought solar panels or a particular asset for your home and you got a loan on it. But UCCs basically establish positioning. So if you filed yours first, that means if somebody's trying to recollect capital and there's an asset, they have first rights to collect. That's why that matters. And I think for business owners, as they think about this, you need to understand what that means because a lender is less interested in getting into a situation where they're in second, third, or fourth lien position. So that's why that matters. Going into specific types of loans that banks offer, they do offer these asset-based loans that I'm talking about, and that could be on real estate, equipment, invoices, and then you have what they call ABL, that's asset-based. They also will do it against AR, and then there's also factoring in AR financing, and I'll explain the difference in a moment. CDFIs, those are community development financial institutions. They're government run. They're nonprofits. In a lot of cases, they're funded by government grants, banks. They're a partner that really helps with startup capital or refinancing for small businesses. And it's really to help the economy in the local state, city, or area that they're particularly in. And it's for somebody that might not qualify for traditional bank credit. And they're good partners for someone like my firm that's private capital. And they generally offer term loans. And there's generally specific types of loans that you need to think about when you're taking the difference between a term loan and a line of credit. The line of credit allows you to borrow, give it back, borrow, give it back, borrow, give it back. And when you have a term loan, you're paying interest on that money every day. The value proposition of a line of credit is if you know that your business has a lot of lumpy payments, you're not getting paid the same amount every month, or you're growing rapidly, so your volume is growing consistently. That is the value proposition of getting a line of credit versus having a term loan. Traditionally, lines of credit have higher interest than a term loan, but they also give you a little bit more flexibility and liquidity usually. Most of the startups in the ecosystem that thinks about startups, I think you're mostly looking at equity. I give a lot of talks about this, about how I think over the last decade, Shark Tank has really made raising venture money kind of Hollywood. And I think some founders get lost in raising money being more important than selling. And outside of everything you see here, there's nothing more important than selling your product or service. That is the biggest thing that I think you need to think about. And I think when you're doing that, I think that's going to be a really important aspect of your business and how you think about raising equity going forward. Grants, R&D tax credits, it's free money. I think every business that has any type of research and development or any type of tax credit opportunity, you need to understand it, look into it. The experts in those spaces, if you don't have time to look, you can't leverage AI to look. They just charge a fee for what you recover. There's companies out there that do that. I think that's something that every business should be looking into if you haven't. Merchant cash advance, that's another type of lending model, like a line of credit, like an asset-based loan. What it is specifically is they're actually giving you a set amount of money. They're taking a portion of it off top, but their repayment terms come straight out of your bank account. So it is essentially a term loan, but they're attaching themselves generally to the bank account to read the agreements when you do those. There's various ways to get revolving lines of credit, so I'll come back to that. I'll go through these specifically. I kind of went pretty detailed on bank loans, but I think the basic premise of this, even to what you said too, Sophia, when you were asking me the question, bank money is always going to be the cheapest capital. Equity is always going to be more expensive. So I think the premise of this too is you may need equity to raise something if you don't have a minimum viable product yet. But once you generate revenue, I'm always urging people to realize there's a point in inflection when you raise money and you lose control of your business. Meaning you, the founder, don't have control of all the decision making anymore. You've raised enough money to the point where you have to have a board. And there is a good value in doing that, especially if you know that you're not the CEO or founder that could carry the company past a certain point, and you realize at some point you have to leave. And it's the best for the company to grow as fast as it can and make as much money as it can. But I always try to make sure everybody understands the cheapest form of capital you're going to get is generally from the bank. And they generally offer all types of loans. So you have to think about banks from the big banks, the biggest banks in the community nationally. then you think about community banks. They're usually offering a little bit more creative opportunities. So startups thinking about getting money from the banks, usually SBA loans is the best way, but you have to know that's a term loan. So you'd have to know when you're going to start generating revenue before you take that loan, or else it's not very helpful to you. Asset-based loans. So if you're in a service-based business or hardware-based business and you make a particular machine, a particular item, you have real estate, you have some sort of asset, inventory, invoices, receivables. Those are things that you can get cash for. And I think those are things that I think most founders don't have a lot of knowledge about. A lot of people won't train you in this stuff in school. They're generally higher cost than a traditional cash flow bank loan or even those CDFIs I mentioned. And one other thing that I'll share too for the startups here that are still building product. CDFIs generally have a very standard requirement in time in business, generating revenue or profitable. They're much milder than a bank requirement. So I think there's a point too when you're in your raise ecosystem, you might be pre-seed and you might be going to a Series A. Maybe you need a bridge of debt in between those rounds to get the company to a higher valuation before you go to that next equity round. And this is how the founder can maintain more equity in the business. And generally speaking, if you're building an AI-based product, right now it's scale as fast as you can because somebody else might do it faster, better. So I think that's where venture is key. Revolving lines of credit. So the difference between a term loan and a revolving line, I think, is something a business really needs to understand. And this comes from doing cash flow management in your business, really just understanding your gross margin, how much money you have to pay for your overhead per month, payroll, cost of goods, understanding what types of collateral you have to be able to get a line of credit. And I think the key components of this is having a strategic plan on how this can help you grow the business. And this is where I always say having a good finance partner in your business is paramount to helping figure out the right smart capital for the company. Merchant cash advance I talked about earlier. So some typical ones that I see, it's you get money and you're paying it back short term in 3, 6, 9, or 12 months, sometimes 2 years. And usually the payback rates are daily, weekly, monthly, or sometimes even quarterly. In most cases, they're usually weekly, but I've seen daily and monthly. And when they're asking for paybacks more frequently, it's usually a higher interest rate than what you're looking for. These loans, I say avoid unless you truly understand the terms and you really know the type of capital that you need and you can actually make money off of it. In most cases, it's hard to. CDFIs, these are the community development financial institutions that I talked about. For those of you in or outside of California, you're going to have different CDFIs outside of California than I'm familiar with in California. So it's worth looking up in your own communities if this is something you want to learn about. They're usually heavily engaged with small business development centers, which is another government-run organization in your own communities. They're pretty frequent in our area here in California. So for those of you who are thinking about equity, I think the biggest thing you're building when you're selling equity is you're building a product that has intellectual property, or you're a founder that's got proven success, that's driven someone that says, I want to invest in this. And I will argue this is the most expensive capital you can get, but it allows you to grow as fast as possible. That is the benefit of it. And if there's anything I could think about how you all are thinking about raising equity money, which seems like a majority of the room, I just urge you to think about it more strategically for yourself. Know what your business is, understand what the value proposition is you're bringing to the market, how fast you need to grow versus other competitors in the market, And are there points where you could get smarter capital that isn't as expensive? And I think that's one of the things that why I give this conversation, why I built this presentation, is I was saying earlier, to try and pull back the layer on what Shark Tank has kind of made equity kind of a Hollywood play. Grants and R&D tax credits. So again, this is going to be the cheapest money you'll get out of all of this. So for the other individual that's an MVP, building out product, if you're building something that benefits society, benefits state government, humans, individuals in a positive way that will help the government, help the economy in any way, there's probably some sort of grant or R&D tax credit that you can get for it. This is really prominent in anything in the medical space, but I would say energy conservation companies, even food research, health related items. I think there's a lot of opportunity there, but I think in most cases, right, like companies miss these, and sometimes they take a lot of work. I'll give you an example. One company that I met last year, I think they had raised $10 million in grants, and that was a majority of their capital beyond the equity money they raised. But I think that the key part to that is you need to understand your time evaluation versus what the grant's requiring. Because sometimes they can be pretty stringent on underwriting, but I think AI has really fast-tracked this space and your ability to be able to research this. It's a good question, Kalani. I can talk to you a bit more about that offline. I would have questions for you. So I'm going to go a little bit about what my business does specifically. And I think this is something that I can talk about. Well, I figure everybody doesn't want me to list best to worst because I need to ask questions specifically. I'm answering the chat question. I don't think there is a best to worst on this list. I think it's dependent on your business and where you're at in terms of revenue and your product. I'm going to deep dive more about what our company does. So I think a general founder has this expected level of cash flow. You think I sell something, I make more product, I sell more, I make more money, and I collect more money. And then my cash balance as a business continues to grow up. But reality is when you sell something, especially if you're selling to enterprise companies, that's where you make the massive growth. You become a very big company and you start generating a lot of reoccurring revenues when you get into enterprise, larger, mid-commercial businesses. They have payment terms. They take longer to pay you. Generally, they're not going to pay you with a credit card immediately like you might think. So if you're selling to another business, you have to plan for what's going to be cash flow gaps in the business. You have to know when they're going to pay you. And they might have terms that tell you when they're going to pay you, but you have to have a little cushion there because they might say, we'll pay you net 45. But if you input everything in their procurement process incorrectly, it might take longer. It might reset. So you have to prepare for these things in running your company and have what I would call a safety net. And that should be either with cash, other equity partners, a way to draw on a line or to get other capital. And this is particularly when you're banking on that revenue to come in. So the key things that you need to understand is what your gross margin is on what you're selling, how much your overhead is going to go up or down as you sell more. Know how much revenue you're going to be generating at the end of the year. You're going to be operating at a loss. In other words, in startup world, you think about your burn rate. And try and negotiate better payment terms when you're a startup. As soon as you can, a lot of these companies have various things in procurement departments when you're in the enterprise level that the procurement department is actually incentivized to pay you later. Meaning if the procurement can get you from net 30 to net 45, that's an incentive for the person in that role. You need to be good at negotiating when you get in those positions. And as a startup, you might not feel like you have power. But they want your service and they're going to want you to operate effectively. So your payment terms matter to be able to do that. And cash flow position, I think it's good to do projections based off of booked revenue and what's in your pipeline. A lot of companies will do pro formas, but I think even more so beyond a pro forma is you have to know when you're going to collect the money. When I'm doing credit analysis, when I'm lending to companies, we tend to specialize for small businesses in construction, less in startups there, software-based companies. A lot of the reason being in asset-based lending, if you're lending off of receivables, software companies, AI companies usually bill before the work has happened. So that's less valuable collateral to a lender. Why that matters is if you plan on getting any type of credit or revenue-based financing down the line for your business, they will want to see contractually obligated payments at a minimum, if not having billed after the work had been completed. Government contracts are usually tougher for a lender to do as well because there's no recourse if they don't pay you. Healthcare, there's HIPAA laws on being able to understand exactly what they're billing for. And then CPG, so when you're selling food and beverage or anything and you have a distributor, there's a process in between shipping and delivering where they might take money off of your invoices. So you might invoice 100K and you might have an average discount rate of 10%, meaning they might actually pay you 90 when they pay you. I know these are a lot of different industries that a lot of you are not in, but these are the specialties of our company as a company that offers credit and capital. We're a generalist. We work and specialize, I would say, in these spaces because I run into a lot of lenders that don't quite understand these spaces. This is an example of a company that's maybe in software that has a $300,000 cash position, and they run payroll every 2 weeks. They have a biweekly payment to their service provider that's maybe doing web hosting or data hosting. And that number will probably go up over time. Payroll will probably go up over time, but usually in software, you're running at a high gross margin. So I'm showing this company here gets down to about negative $500,000 in 8 weeks, and they're making sales every week. And the reason why this matters is they are profitable by the tune of 900K in this 11-week time frame. And this is what I'm talking about, understanding when your clients pay you and why this matters and how much money you have and understanding your burn rate. So this company is profitable, but they're negative cash flow, which can't operate. You can't pay your staff if you don't have cash. So that's why understanding all these things matter. And the other part is this is a tough deal for a lender because they're billing before the work happened. So the company that owes you the money might not pay you because you might not keep the lights on because you weren't able to make payroll. So your asset becomes distressed. This is kind of more how it's going to look. Typically, if you don't have any finance partner in that type of situation for that type of company. And this is kind of where we play in the mix. So if I'm financing, I will finance against the invoice. So this is the AR financing specifically. I'm giving them 80% of the value, the 20% cushions to make sure that I have more than enough room to get paid my interest when the invoice pays. So over time, I'm giving them, I think it's about $1.5 million over 9 weeks. So this is a new funding amount every time, not a total amount outstanding. And then the interest rates pay about 19K over this time frame. Now, granted, the cash goes as low as about $20,000, but in this scenario, this company didn't give up any equity. They were able to make their payroll every time they had to make payroll. And then the key purpose of this is really to get them to a point where they don't need the debt anymore. And you see in these last 2 weeks, they didn't need to fund. But the key component of that is they're probably going to have to fund again because they get to negative to 48,000 here and they have payroll again in week 12. But they're growing very sustainably. They're going to make more money because they have the funding partner. They can take on the more work and sustain the growth and get to a point where they're able to run without any debt. And this is the example of the types of companies that we're working with. But we also work in various other industries where it's a bit more complex, but I'm showing this more for illustration purposes. Yes, I can share the slides. I see a couple of people that ask that question. I don't mind sharing these. I don't find these to be proprietary or anything I need to worry about. So the point I was sharing earlier about how the company got to negative $500,000, now they're never as low as 20K. They did pay 19,000 in interest, but they were able to realize all of that 900K in profit, whereas before they would have had to stop operating. And that's kind of the key component to understanding debt versus equity. In most cases, a company that's just focused on equity and not thinking about debt, that's in that scenario, they're going to go raise a convertible note, and
Well,
maybe they're hopefully able to pay it back in interest or a bridge round of some sort. I see a few people asking people to mute. I'm giving it a second. Okay. So I wanted to address a question I see here. How does this play when a company is receiving royalties? To clarify on that question, if you can answer, I'll continue. Is your business model that you're receiving royalty payments and that's your revenue and your only source of revenue? Good question. I think if you're receiving royalties, your cost on your sales should be minimal, right? So you should have a really high margin on the royalties because they're whoever's running the actual business is paying for all the costs of the goods. You probably wouldn't need much financing on the royalties. But if you're saying that there's royalties on the invoice, we would just take that off the top. So say you got a 5% royalty on 100 grand, I would finance then 95,000 instead of 100 grand. Hopefully I answered your question. You can feel free to address that if you want to ask more. So here's going back to the chart example, never get below $0. So that's kind of the key component to what our financing did for that company. This is an overview of our services and again, my contact info, and I'll go back to the top screen for those of you that didn't see my LinkedIn. I'll go back to that. So you guys can connect with me on LinkedIn. I'm probably pretty easy to find on there. But the purpose of this conversation is to share a little bit about what I do, just to give an understanding of where I think startups should think about debt and not just think about equity. And I'm happy to be a sounding board if you have questions about it or if you're examining different options. I think for those of you that are trying to raise money, which seem to be a majority of the group in the beginning, I'm not the right advisor, so to speak, for that. But I'm happy to talk to you about it. Obviously, we work with investors, venture funds, small funds, seed funds, other equity and debt players. But we definitely have a lot of conversations about capital. I'm going to go back to the beginning, allow any of you to connect with my LinkedIn here if you want to reach out or chat with me. And I saw a few of you may have sent me an email, and I hope this was helpful. So I'm going to start addressing some of these questions. So somebody was asking about anything for consultancy or compliance, a HIPAA, and AI compliance. So I'm not sure I quite understand the question, but HIPAA, healthcare related. So if you're financing somebody that's got receivables directly tied to insurance of patients, the lender's not allowed to see the patient information. So they would be lending off of projected receivables on a monthly basis, usually. So they technically wouldn't really be able to see the invoice. So they'd have to build some sort of other method with the lender to be able to do that. When you're talking about AI compliance and cybersecurity, I would imagine that AI compliance is still being written today. Not my area of expertise, but when it comes to lending, I think from a credit standpoint, AI is not there yet to me. I think it's a good thing that helps speed up efficiencies in this space and looking at the legal place in it. But I think it's not quite there yet. It's not getting things right yet. I think you have to train your AI a bit more. But I'm using AI for a lot of different things, and I find it making mistakes pretty consistently. When it comes to credit and doing evaluation on this stuff, it can't be wrong. So you need to have somebody that's really good at communicating with the AI to do all that stuff. Do VCs like, I'm going to read this question. Do VCs like companies to think or raising capital in other ways, or it will force us to raise capital all the time? It depends on the VC. I think it really depends. I think at the end of the day, you need to understand a VC's working for their LPs more than they're working for you, right? So they're getting paid by their partners who invested in the fund, and they need to get them a return on their money or they're never going to go in their next fund. So they want to make sure your business has an exit. So usually those are usually beneficial to all parties, but I think in some cases the founder may not want to exit when the VC fund wants them to exit. So that's the part where the control path matters. Or maybe you're operating the company where it's not growing to the speed of the multiple they want to make on their investment. So that's where it becomes tricky. Got it. We got an AI governance expert here. Nice. Yeah, I will not speak to that or act like that's an area of expertise for me in any means. I know we scheduled an hour and I probably stopped a little short, but does anyone else have any other questions? Oh, I see a raised hand. You can talk. Go ahead, Matt.
Thank you very much for your presentation, Paul. I wanted to ask about whether a recording of this will be distributed to us participants. I know both on LinkedIn and the talk. It was advertised through a bunch of groups. So I wanted to know when we might see that. I do have a team member that does need some like has some different needs to essentially read the captions, and so I'd want to know how the recording will present and whether those will be present. I also want to ask about a question about these different methods and how to figure out whether we can go with or essentially to avoid pushback if certain members on our team are a bit reluctant to pursue one or the other, and like basically how to counter objection, so to speak.
Okay. Let me answer your first question. So I should be able to provide the recording out within a week or two. So don't commit me to that. The second part to your question, as far as like understanding which options make the most sense from what I was presenting. If I go back to that other slide, am I getting that right, Matt?
Yep.
Yeah, I think sometimes the cheapest capital is not the smartest, right? So really it's understanding and projecting where the business is going in the next 6, 9, 12, 24 months and figuring out what that capital unlocks for you based on when and how you get it. So in my case, I love working with companies that say, if I had more money, I could sell more. Now, my interest rate might be higher than a bank, and that company might qualify for a bank loan, but the banks typically need to go through a reapproval process if they want to raise your credit line. And I can raise your credit line almost immediately. So if you're making like 40-50% gross margin on your product, or in that tech company example, they're probably making 80-90%. And I'm taking a small portion of that margin, but I was able to continue to raise your credit line.
And I know you talked more of banks. You just tabbed a little bit on angel investors and investors. I'm want to know more about that area instead of banking.
Yeah, about angel investors. So
Or just these investors, VC investor, angels and investors.
Yeah. So the way I would think about angels, a typical angel organizations generally run where they have a membership of people that want to invest in small businesses but don't want to put money in a fund because they essentially want to decide the exact companies they want to put their money in. And there's angels that don't associate with an organization, but the ones that do, typically the way the organization is structured is the organization gets a carry or warrants some sort of equity for facilitating the transaction, for bringing the two parties together. Another model is there's some angel organizations that will charge you a fee to pitch to all their angels, but they don't take any equity. So there's a couple of those. And then the other side of it, right? Like people usually say go to family and friends first. Your family member or a friend might actually be an angel themselves. I mean, there's the term you have to be an accredited investor, which I believe is make at least 200K a year and over $1 million in net wealth, one or the other. That's I believe that's the typical for being an accredited investor. I believe going to angel organizations, usually people go one route or the other. They usually go the more venture capital route, or they go the angel investor route. I tend to find that angels don't expect as high of a return as a venture fund would because there's less players. Because the fund has to make money to operate, and then the LPs are in a broad investment scope in multiple companies, but the people running the fund have to get paid. So I tend to find that they generally want a higher return on the capital than a direct angel would. So you'd have to ask yourself over time, how much money do you think you need to raise to determine what's the best route for you? But I think when you're in a place where you're looking for strategic investors, that's the best, right? Like where you have somebody that you can take money from, but you want them involved in helping. So what route should early tech startups like pre-seed take? Incubators. You know, I really think you should value your relationships, the ones that you've built and the ones that you're forming. I always believe when you're talking to anybody about money, you're going to want to have a relationship where this person communicates the way you do or that you understand, or else it's going to be hard for you to ask questions or go through the things that you may not understand or not know, especially in a working relationship. If you want them to invest and be a strategic investor and help you, I think I would value that more. I know from the investor side, most of the really well-known investors that I know and that have done well in investing, they value the founder almost more than the product. And they're evaluating them probably more than what necessarily the business is doing or done. Because in most cases, a really innovative startup has created something that's never gone to market. Okay. I'm looking at more questions. Any other questions? So if a client has equity financing safe, does your loan availability change? Good question. You know, our loans, the capital we offer, our rates are purely based on two things: the cost to us to provide the capital versus putting it somewhere else. And I'll preface, it is our money. And then the second part about it is just how financeable we think the opportunity is. So we might offer a lower interest rate if we feel very confident in getting paid back.
Is your payback immediately like banks, or is because if it's a startup, it's going to take some months to up to a
Good
year.
question. Well, so the example I showed, right? I'm lending off of invoices, so it's a short-term revolver. So I'm giving you money based on a product or service you already provided, or you're contractually obligated to provide, and they owe you money. So I'm covering a business's cash flow gaps on a revolving basis. So whenever you invoice somebody, they haven't paid you yet, I make sure you have the money now because you might need it before they paid you. So in a lot of cases, hence the name of our company, Marble Bridge, the bridge part is for us really to get you from point A to point B. And that could be in a month, it could be over 3 months. But you're allowed to use it over and over again, is the idea. Kalani, your second part question, I think it's going back to me.
Hey, Paul, can I
Yeah,
talk? No, I don't
yes,
see the
please.
option to raise the hand, so I just talk. I'm sorry about that.
You're fine.
Yeah. So the thing is, I'm really looking as my product is almost 80% to MVP. I'm looking forward like where are the thing like what are the places where I can connect to incubators, or like I know that we have to apply online, and I have did for a few of the companies, but I'm looking to connect to more people and get to know my options better.
Where are you located?
I'm in California. I'm in San Jose.
Okay. Yeah, I know you're an MVP, maybe a little more. I think you were the one also said stealth mode, right?
Right. Yeah. Yeah.
Okay. So let's schedule a conversation and you can share what you can share. We could talk about a couple places that might be worth you checking out.
Sure, sure. Why not? Yeah, I will get connected with you on LinkedIn. That's fine, right?
Yep.
Awesome. Sure. Thanks, Paul.
You're welcome. Anyone else has any other questions? Appreciate everyone joining. I hope this was some value add. I generally think when somebody hears a presentation, you might not learn something from everything they say. You might not agree with everything they say, but I hope you all gain something from it.